common New Year's resolution I come across is I want to save money, and you may be thinking to yourself, how do I achieve this? One area you can look at is, if you do have any outstanding debts, is look to consolidate your debts onto your mortgage. Today I'm going to give you the pros and cons of consolidating debts onto a mortgage, and I'll also give you 4 key questions to ask yourself as to whether it's right for you. I'm Matt Poole, welcome to Mortgage Monday. Firstly, what is debt consolidation? Debt consolidation is where you take one or more pre-existing unsecured loan and roll it into your new mortgage. For a lot of people, the main goal of a debt consolidation exercise is to ultimately save money on a monthly basis. You need to be careful when you're looking at debt consolidation though. It's not for everybody, so you need to ask yourself the following questions to make sure it is right for you. The first thing you need to do is look at what debts you have outstanding at the moment, and then ask yourself these following questions. So firstly, what is the debt? So is it a personal loan? Is it a credit card? Is it a car finance? Is it a mail order account? Secondly, ask yourself how much is outstanding on that particular debt. For the amount outstanding, if you have a mail order account or a credit card, it will be really easy to find out what the balance on those is just by simply looking at your up-to-date online statement. If you have a personal loan or a car finance outstanding, sometimes it can be a bit more difficult to find out what's outstanding, but you should be able to get a settlement figure from the provider quite easily. The third question to ask yourself is, what is your current interest rate? So on a personal loan or a car finance, that will be a fixed rate of interest. If you have a credit card or a store card, mail order account, the interest rates can be a lot higher, quite significantly higher actually, and they can also be variable, so it's always good to check what your current interest rates are. And the fourth question to ask yourself is, how long have I got left to pay on these commitments? So for a personal loan or a car finance, a set finance agreement, it will be really easy to find out how long you've got left on those by looking at your credit agreements. If you have an open-ended credit, like a credit card or a mail order, a store card, they can be very flexible. You could pay minimum payments, and it can actually be quite difficult to work out, based on your current interest rate, actually how long you've got left to pay on that particular debt. If you are looking at debt consolidation onto your mortgage, it's always worth speaking to a qualified advisor, as they will have a better insight as to work out what the overall picture is for you. What a broker will do is they will look at all of your debts, not just the ones you're looking at consolidating. So a broker can work out which ones it's worth consolidating, which ones it's not, and from there you can formulate a plan around that. A broker will also look at the overall picture of the actual debt itself as well, so looking at the current interest rate, the monthly payment, the current outstanding balance, and ultimately how much it will cost you overall on the current circumstances. What a broker will also do for you then is actually work out, so if you consolidate these debts into your low rate mortgage, although it may lower the interest rate quite significantly, is it going to work out that you pay less overall compared to the current terms? And ultimately, that is what you want to achieve by paying less overall, as well as reducing your monthly payments as well. By using a broker for this type of exercise, they can give you a really comprehensive overview of everything and just make sure you are doing the right thing for your circumstances. Let's now look at the pros and the cons of consolidating debt. So there's a number of pros to consolidating debt, including the main one, reducing your monthly outgoings. You may also be able to lower your interest rate quite significantly on your current circumstances. Ultimately, refinancing commitments will also simplify your finances as well, potentially just one monthly payment to worry about rather than having payments all over the place. And ultimately what you're looking for this exercise is to actually pay less overall. So once you consolidate a debt into a low rate mortgage, are you going to pay less overall? That is the ultimate goal. A couple of things to be wary of when you are looking at debt consolidation. You may pay more interest in the long run, so it all depends what your ultimate goals are. If your priority is to save money, it may be right for you. If you want to save money overall, it may not be the best option for you. And the second thing to consider is, if you are refinancing unsecured debt onto your mortgage, that debt will then become secured against your home. And as always, remember, if you don't keep up repayments on your mortgage, there is a chance you could get repossessed. So just be wary of that as well. Just to recap then, so if you are looking at debt consolidation, there's a lot more to take into account rather than just looking at saving money on a monthly basis. There's also many other factors to take into account, such as what you will pay overall, the interest rates you're paying compared to what you can pay on a mortgage. Ultimately, the best thing to do is get in touch with a mortgage broker. They can lay it all out for you in black and white, and they will give you the best options. Thanks for joining me this week on Mortgage Monday. Remember, you can follow me on LinkedIn, subscribe to YouTube. Thanks again. See you next week for Mortgage Monday.